Everyone out there is trying to time the market perfectly. It is impossible. Every great investor, everybody who has knowledge of money has said this over and over. You can't possibly get to the point where you're timing the market perfectly. So what does work? I tell everyone in our community over and over. Warren Buffett, Charlie Munger, every great investor says the same thing. Dollar cost average. Charles Schwab wrote an article recently where they looked at 20 years of data and looked at perfect timing, bad timing, dollar cost averaging versus one time a year buying and versus T-bills. Well, I wanted to go one step further. I hired our research analyst from our Everything Money community, Dalton, and said, Dalton, let's go back 30 years. I want to go further than 20 years. See, maybe the last 20 years were a fluke because the market was not so great over the last 20 years. And this is the data that I came up with. But before we go any further, if you've watched our videos before, I always show this chart. This is where the market should go over time. But this is what the market actually does. Ups and downs, okay? What ends up happening for most people is they buy here and they sell here. Why? Very simple. Because of emotions. We get so euphoric and excited here. Everyone's making money. I can't miss, etc. And down here, everything's losing money, so I'm selling everything. That's what usually happens. And there are studies that show that people who just try to get in and out of markets may trail the markets by upwards of 6 or 7% per year in their lifetime because of the fact that they're trying to time markets perfectly, but all they're doing is reacting to emotion. So what's the better way? Well, very simple. Dollar cost average. Pick a point. Is every month, every week, every quarter, once a year, whatever it is, but you stick to a plan of buying month in, month out, year in, year out, exactly systematically. And sometimes you're going to overpay and sometimes you're going to underpay. But over long periods of time, you're going to match the market. And remember, actively managed mutual funds, only 18% on any individual given year can beat the market. And over a 10-year period, that number drops to 2 to 5% of actively managed mutual funds will beat the market. So just by doing this, you're going to beat 95% of mutual funds at least. 95% of those Wall Street wizards out there who really can't do any better than you. So what I'm trying to teach you is doing exactly this. So let's go look at the data. But first off, if you're new to this channel, I'm Paul. I'm a value investor. I believe in looking at the quantitative aspects of a company in order to understand further if I should go deeper into the company. I don't buy based on hype. My goal is to buy $1 for 70 cents or less. Now you might wonder, how does that happen? Well, I look for mispricings in the market. I look for opportunities where people are mispricing data because I believe that the pendulum swings from side to side. And when people are euphoric, they're overpaying for growth. And when people are despondent, whatever you want to call it, they're underpaying for the potential out there. That is my goal. If you want to see more about me on a personal side, to see that I'm not just some robot, check out my Instagram, where you can see more individual pictures of my family, my dogs, etc. But going back to it, I had one of our research guys in our Everything Money community sit there and go through the data going back to the S&P, back to 1988 until 2022. That's 34 years of data. What this does is it sat there and said, okay, if somebody bought at the beginning of every year, at the best part of every year, at the worst part of every year, and did T-bills as well as dollar costing every single month, month in, month out. This is the response we got. Perfect timer, Paul. If you'd invested $5,000 a year for those 34 years and you'd been perfectly timing it, which means you bought at the lowest point every year, you'd have $618,000 at the end of the time period. If you were start of the year Seth, and you just bought $5,000 at the beginning of the year, which is a version of dollar cost averaging, you'd have $562,000. If you were dollar cost Dalton, which means you bought systematically month in, month out going forward, you'd have $520,000. If you were miserable timer Mo, which means you bought at the absolute highest point every single year, $498,000. And if you did T-bill Tim, you were $246,000. So what does this show? Look at the difference between start of the year Seth, dollar cost Dalton, and perfect timer Paul. Is it substantial? Sure. But guess what? This is impossible. In addition, this assumes you buy every single year. But here's the issue. Bull markets and bear markets last for multiple years. So if you get out of the market because you're too scared for more than a year at a time, that is not factored here. That's going to drive your returns down here and your returns down here. So even the best case scenario where you still commit to buying every year, whether it's the top or the bottom, and you're still perfectly timed, that is still going to cause a problem. Because remember, when things are euphoric, you're going to believe they're going to be great for longer, and you're going to be buying bad stocks at bad times for a long period of time. And if you're miserable and worried about the future, you're going to avoid stocks for way more than a year. But guess what? Look at these two things right here. The people who just dollar cost averaged did very, very well. And the best part is you slept well at night. If you believe the markets are going to go up, which is a belief in the U.S. economy, that it's going to grow and grow and grow, then why would you do anything else but this? Why? What's the purpose of that? You're still going to have a ton of money in there. A ton. Why deal with all the anxiety of trying to guess what's going to happen today and tomorrow or next month? Why worry about what's the Fed going to say? All you care about is, I'm just investing. That's all I'm doing. I'm putting my money to work. That's it. And I'm going to wake up 30, 40, whatever the number of years later, and I'm going to have a lot more money. That is the key. From 1988 until 2022, that's when this goes. What have we had? We've had Gulf War 1 and 2. We've had 9/11. We've had the Great Recession and financial crisis. We've had 2 presidents impeached. We've had all these bad things happen. We've had terrorist attacks beyond 9/11. We've had so many bad things happen. And look where stocks went. If you just invested month in and month out, year in and year out, they still went up. That is the key to all of this. Now, as a channel, I'm trying to teach value investing. But a big part of value investing is the emotional aspect of investing. It's about saying, I'm okay seeing all these bad things happen and keeping my eye on the prize and finding good companies at great prices. Now, what does that mean? It depends on the size. The larger the company, a great price might be 20% lower than what it should be. The smaller the company, it could be half the price. It all depends on where you're looking at it from a matter of perspective. But this is the key here that I want you to remember. I want you to take the majority of your money. If you want to buy individual stocks, please go right ahead and do so. My path to value investing was majority of my money in ETFs and a portion in individual stocks. Now I do 100% of my money in individual stocks. Why? Because I feel like I have the emotional fortitude to be able to look at stocks and companies as they go down in price, to reevaluate. And as long as my thesis is the same, I continue to buy more. That is what I have done as a value investor. It's not for everybody immediately. It takes time. But along the way, the best thing you can do is build your immunity to markets going down by learning the dollar cost average. That takes a lot more effort than you would imagine. But once you own that, you can really dominate and you'll do so much better than everybody else in the markets. In our community, we have this community of investors. We have thousands and thousands of people in this community talking every single day. And even with these people, a lot of them will dollar cost average into low cost ETFs for the long run and still pick individual stocks based on a value approach. We have tons of conversation here about both. Why? Because we look at red days as an opportunity for buying. That is the key here. You look for red years as an opportunity to buy. If you go back to the early 2000s, there were 3 years in a row of losses to the S&P. That was an opportunity for so many people. If you go back and look at that, you wish you were buying at the bottom, but you couldn't have possibly guessed when the bottom was going to occur. The goal was to buy every single month, year, quarter, whatever your dollar cost average number was, and buy for the long run. If this makes sense to you, please watch more videos, especially this next one on margin of safety and how I look at that to buy my stocks. Thank you very much for your time, and please subscribe to the channel.